Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Ron Diamond, Chairman and CEO of Diamond Wealth. We have Jack Ablin, Chief Investment Officer of Cresset Capital, Ryan Eisenman, CEO of Arch, and John Wieker, Chief Investment Officer of Coinvest, to discuss why the family office market could be bigger than private equity and venture capital combined. Gentlemen, it's great to have all of you with us. Welcome to Trade Talks. Welcome to Market Site. And Ron, we'll kick it off with you. That's a pretty big statement that this could overtake those two big markets.
Well, there's currently $10 trillion in capital in family offices, and just to put it in context, there's $6.5 trillion globally in hedge funds. But you've got $84.4 trillion moving downstream from the baby boomers to the next gen in the next 20 years. So it'll be the largest transfer of wealth in history. So this market will be larger than private equity and venture capital and hedge fund combined. So it's massive, but it's still very early. It's still very inefficient, very fragmented, and very siloed. And I would say 25% make it to the second gen, 10 make it to the third, and 5 make it to the fourth. So there's a lot of work that we have to do in the family office space.
So Jack, how are investment strategies evolving within the family office space? It sounds like it's certainly evolved past the 60-40 model.
It has, and that's really one of the things we're doing at Cresset is understanding that private investments is a critical piece of the puzzle for family offices. We have to keep in mind that families, the wealthy families that have the wherewithal to create a family office, probably earn their wealth either with a private business or real estate. So already the kind of the key driver of their wealth is from private assets, and we needed to make sure we had an adequate way to access private investments for these clients.
Right, and Ryan, it sounds as if that this is beyond the traditional investment advisor role as well. I mean, there has to be some, technical expertise here.
Yeah, well, when you look at investment advisors, we've seen a lot of folks move to becoming more multifamily offices. So they're trying to provide services beyond the scope of a traditional 60-40 portfolio or even just being an investment manager, which requires a lot more expertise, which Jack and his team at Cresset have put in place, and then also requires more tooling and kind of more sophistication to support those kind of clients.
Right, and John, looking at beyond just stocks and bonds, I mean, you have an interesting space in which you think is attractive, or where you're seeing more interest.
Yeah, family offices are one of our largest investors. So at Coinvest, we're a vertically integrated provider of niche housing. We're focused on student housing and BTR. We're the largest developer in student housing today and have over 40,000 beds across the country. And it provides a great diversification from most people's typical multifamily portfolio or just office and industrial portfolios. Student housing is actually recession resilient, and so the cash flow stream is very different than typical housing.
Yeah, Ron, are you seeing the younger generations have interest in different areas than perhaps where they have inherited money from or where this money is being handed down?
Absolutely. Certainly, they're much more tech savvy. They're also more into impact investing and things like that. I think that the whole impact investing, it started with the younger generation going up rather than the older generation going down. I think they're much more comfortable with newer technologies, and if you look at my generation versus my daughters who are 20 and 23, I would argue there's been a bigger change in between my daughters and myself. You can go back to the Industrial Revolution because technology's changed so much. So it's been massive.
Yeah, it's certainly like, not picking the blue chip winners, but okay, I want to get in the angel AB rounds of the next NVIDIA is what it sounds like.
That's it, and I think the time horizon is really the differentiator. So, I think one of the things that a lot of U.S. investors focus on is, in public markets is, a quick buck. And when you engage in private investments, you have to really be in it for the long haul. And so that requires really matching your time horizon with that underlying investment.
Right. So, I mean, John, thinking about the perspective of a direct deal versus the liquidity that you might have getting in and out of a stock or bond portfolio, what should family office clients be aware of when it comes to constructing these types of deals? How should they be thinking about that?
Yeah, well, I think the most important thing is to focus on your location and make sure that you have a forever location, and then you can think about your investment on a very different time horizon. We're maniacal about making sure that we're focused at the perfect location within each university that we focus on. These quads haven't moved in 100 to 200 years. So if you know where that quad is, you know where that retail corridor is, you can pick the perfect location and know that you have a piece of real estate that's going to last forever.
Yeah, I mean, the addressable market is huge. Look at how universities look relative to 20, 30 years ago. when we were in school.
That's right.
It looks completely different. We were talking about this off camera. It's like, tier A office buildings and what the next gen is expecting.
That's right. That's right. And it's what they're expecting. They're expecting purpose-built product that suits their specific needs, not just typical multifamily, but also what their parents are expecting, and that's safety and security. And so the product looks very different to suit those two needs.
Yeah.
And my daughter was a beneficiary of, she's graduated from Michigan at the Hub, which they built. It was a phenomenal facility. But yeah, it's a lot different than when I went to college.
Yeah, well, I mean, I'm sure your daughter thought about, or perhaps folks within her generation, with the sustainability aspect and the ESG aspect of how the building materials were sourced, how third-party vendors and so forth. That seems to be a key area for the younger investor, Ryan.
Yeah, I think it matters. And different people measure different parts of their investments. Some people only care about returns. Other folks want to invest in stuff that is good for the world and good for their pocketbook. And so we focus a lot on helping people measure the attributes of their investments that matter the most to them, and giving you a little bit of underlying transparency into what is a fund. Well, a fund is a basket of underlying securities, and maybe you want to know, okay, I actually own a lot of Stripe or SpaceX, and it's not just a Sequoia fund or a Blackstone fund, and then that makes it both more interesting and potentially more aligned.
I would imagine as a client of a family office, as you're bringing a lot to the table, that you should expect that. I mean, why wouldn't your family office manager provide that? Because to your point, everyone's investments and their personal attitudes toward it is very subjective.
Well, before you invest in private markets, you probably expect to have the same beautiful brokerage experience that you get when you go into JP Morgan or Robinhood or Fidelity. But the reality is today, most private markets operate off of spreadsheets and some kind of share file or Dropbox. So what we're doing at Arch is digitizing private market investments to give you a way to track and understand those investments so that you can have that feeling of stability that you can make good decisions off of.
Right, but you shouldn't be checking, I would imagine, deals such as this every day.
That's it, and I think one of the great things about private investments does force that longer term discipline. In fact, for our purpose, one of the things we'd prefer to invest in direct deals because we're more closely aligned with the underlying investment versus, say, a fund of funds where perhaps the general partner is more interested in maximizing their fee, and they'll flip an opportunity before really it's due.
Well, Ron, let's take a step back here for a moment. How would I know if I qualify to be a family office client? What do you have to bring to the table? Is it a team of accountants, attorneys, investment advisors? What does that process look like?
That's a great question. I argue 85–90% of the family offices that exist shouldn't exist. You need a minimum of $250 million in order for it to make economic sense. Otherwise, you're better off going to a multifamily office. What happened is post-crash, pre-COVID, all the family offices wanted to do direct deals. And they wanted to do it because they didn't want to pay the fees for the great services. And they made money, so it worked. And they were doing really well. And then 2 years ago, they jacked up interest rates, and now not only were they not making money, they're losing money. So I think what's going to happen is there's a backlash. And a lot of the family offices that did direct deals, Cresset's got a huge team doing this. If you're a family office, and you've got a team of 1 or 2 people. Now there are family offices that are large. You don't have the bench to do it. So I think a lot of the family offices are going to basically outsource now some of their direct deals, do what they do best. If they made their money in real estate, they'll do real estate, and they'll outsource the rest to a firm like Cresset and let them handle it.
And the other point on that is co-invest. So for example, if you invest in a fund, and that's a pool of investments, oftentimes that general partner will maybe buy a position that's too big for their fund, so they'll offer a co-investment opportunity to their other investors. Well, if you don't have the wherewithal to diligence an individual deal, and most limited partners don't, you're going to miss an opportunity to perhaps invest in something really solid and not have to pay all of the GP economics associated with it.
So with the family office, would one family trust, for lack of a better term, would all of their investments be there?
Generally, when someone comes to Cresset, we kind of view it as what I'll call a fractional family office. So if you think about you want a family office and you want all the services, it's almost like flying in a NetJet. When you're sitting in a NetJet and you're flying from one place to the other, you feel like you own that plane. When you are a family office client at Cresset, you may be only taking up a small share of our resources, but your experience is just like you own the family office yourself.
Yeah. So John, do economic and market challenges, I mean, we experienced a lot of volatility certainly this week, does that impact the particular vertical where your expertise is with student housing?
Yeah, student housing is actually recession resilient because if you think about what happens when there's an economic downturn, people either stay for a 5th year of school or they go back to school when maybe they weren't thinking about being in school because it's harder to find that job that you're looking for. And so what you see in student housing is that the enrollment growth and thus like our occupancy and our rent growth is extremely consistent across economic cycles. And that is very different than multifamily. It gets back to what we were talking about earlier. It creates a very different cash flow profile, which allows for diversification for investors.
Yeah, and Ryan, let's talk about risk management and governance for a moment here. Or do family offices, do they have to live under the same rules as you would expect in the financial services industry?
Well, I think one of the interesting things to jump off of what Jack was saying earlier is like when people choose whether to invest in a direct deal or invest in a manager or do co-invest. My favorite quote applied to investing is the Groucho Marx quote of, wouldn't want to be part of any club that would have me as a member. So I think it's really important to think about like when you see an opportunity, why is it coming to you? And is it something that is coming to you because all the Sequoias and Blackstones passed on this opportunity and now you're seeing it? So I think that's why people might opt to work with a Cresset or invest in a highly professional manager instead of doing their own co-investing.
Well, I mean, Ron, that goes back to your point that 80 to 85% of family offices shouldn't be in business.
In my opinion, correct.
Why?
They're inefficient, they're fragmented, they're siloed, they don't have the bench. We'll do work with Paul Carbone runs the family office for Tony and JB Pritzker. They've got a team of 65 people.
That's just for one
family. Now, they're a very wealthy family, but remember, they can compete directly with Carlyle, Blackstone, Apollo, and it's a better model because the biggest differentiator what family offices have, and it is a superior model, they've got patient capital. There's no shot clock. So what happens is a company buys a company, privately held company, they'll hold it for 3 to 4 years, they'll sell it to another private equity firm, they'll hold it 3 to 4 years, sell it to a third private equity firm. So over a 20-year period, you could see this company change hands 4 times. A family office will simply buy the company, hold it for 20 years, let it compound. If you look at the taxes, the friction and the inefficiencies and the disruption in business, it's not even close. The problem is very few family offices have the infrastructure of the Pritzkers. I think what's going to happen is in the next 5 to 10 years, that's going to change as all the money's starting to move downstream.
Well, I mean, $85 trillion, that's a lot of money to be invested. Are family offices under the same types of regulations that a financial advisor would be, or is it because of the private nature of the investments it's different?
Absolutely not. And that's one of the reasons why some hedge funds say, I'm just going to create a family office.
Right.
There are much less regulations with family office. There is less restrictions than I think you have freer. And more people are getting into it. And I think that we're really only in the 2nd or 3rd inning in the evolution. Because I think right now, the top kids out of college want to get into private equity or venture capital or real estate. In 5 years, I think the first choice of these schools is going to be family offices. But it's not, we're not there yet.
Right, but I would agree with you there because, again, younger investors seem to have more exposure relative to when we were younger, not just because of the technology involved, but they seem to be more curious and understand these deals perhaps better than we may have because of their exposure to technology. Do you think the family office space is doing enough to recruit or bring on the next gen of family office professionals?
Well, they're certainly trying.
Or is it like a secret kind of club almost?
Well, it's family first.
Right.
And so I will say culturally, it is different because no matter how good you are, you're either in the family or you're not part of the family. And so what families are doing is certainly trying to cultivate the next generation, whether it's their investment acumen or just the family values. So governance and intergenerational communication is a critical piece. Whether they're doing a good job of recruiting from outside, I'll defer to Ron on that. I don't
because
know
a family member can manage the family office in theory.
Correct.
Sure.
But we put together, I chair the Disruptive Technology Advisory Board at Stanford, and we put together a family office initiative. And the goal was very simple, basically to educate the market on what was going on with family offices and educate the students. More and more of these universities, we're in the process of working with another major university, it'll be announced publicly in the next 60 days, where we're going to have a full-blown program where these kids are going to come out of college and learn about family offices, learn about patient capital, and it doesn't have to be just private equity, venture capital, or real estate. I just gave a lecture at Oxford, and they're putting together programs. I do think we're at the very, very beginning, and I do think in 5 to 10 years, most of the major top universities will have family office programs. Right now, they don't, but it's fun because my world is changing in real time.
Yeah. Well, I mean, it almost has like components of an MBA program. I mean, certain parts of it, or certainly corporate finance class as well. Ryan, what about philanthropy? How do they approach that? Is that a core part of their goals as well?
Yeah, for most of the families, we see that philanthropy is one of like the core pillars of why they exist. It just like it creates a lot of value and it creates a lot of purpose around their work. The way we think about this is philanthropy is this kind of like top of the Maslow's hierarchy pyramid, where you want to create, it's like the most valuable thing, but it relies on a strong base of feeling financially savvy around everything else you're doing. So what we look to do is help people really understand their cash flow, really understand their assets and their liabilities, so that they ultimately can hopefully give more to charity and have more impact out in the world.
But having said that, I agree. I think that what's happening now is family offices are running philanthropies and charities much more like a business. So you look at, my dad passed from prostate cancer at 57. My first boss is Michael Milken. He developed prostate cancer. My dad went to 5 different doctors and he passed away 3 years later. Milken tried to solve it like a venture capital firm. He put $2 million here, $3 million here, $500,000 here, and because of Michael Milken, most men will die with but not of prostate cancer. And you look at what Gates did for vaccines. I would argue he did more than the U.S. government. So I don't think it's a panacea, but I do think family offices who do have a soul are going to solve a lot of these real world problems. It's not going to come from the government. It's not going to come from the big corporations. And I think that's the biggest advantage I think that family offices are going to have, is what they're going to be able to do philanthropically, because these people are passionate.
Yeah, so picking up on Ryan's point, one of the underpinnings of Cresset is goals-based investing. And the lifestyle stuff's pretty easy, right? That's the tangible goals. What are your cash flow needs every quarter for the next X number of years? Where we really have the sort of the art are the intangible goals, and certainly charitable and philanthropy, one of the key pieces there. In fact, I would argue that they're two sides of the same coin. So whether you can be an impact investor and try to grow your wealth that way, or just try to grow your wealth as much as possible, transfer it to a foundation, and then make your impact later, are really two ways of looking at the philanthropy picture and impact picture.
And a lot of these people are really entrepreneurial, and that's how they got to having a family office. And then when you're done being entrepreneurial at one venture, you kind of don't lose that spirit. So then you're like, okay, what problem can I solve? And oftentimes it's like, okay, something like prostate cancer that affected them personally, and then they go at it with like a lot of creativity and a lot of resources as well.
Yeah, and John, you incorporate philanthropy in a different way as well with your projects.
Yeah, we think about putting mental health at the top of our list of how we service our residents and how we think of the hospitality-driven approach to our property management organization. And so what that means for us is making sure that we have programming that helps with mental health and mental wellness, and also career counseling, offering kids what they're going to be doing after school, or guidance on how they can think about what they're going to be doing with the rest of their life after school.
Yeah, and Ron, we'll let you have the last word here as we wrap up. I mean, what does the future look like if you think about it in the next 3 to 5 years? I know you had mentioned that recent graduates might be attracted to this space, but as you think, with the macro and geopolitical environment evolving, what does the future of family offices look like?
I think I'm very bullish on it. I think, look, it is a superior model. The problem with a lot of the private equity and venture capital firms is they became an AUM game, and they started making money on the 2%, and these funds are just too big. I had a friend who did a roll-up of logistics companies. He needed 150 million. Placement agent got him 500. He just said he just needed 150. Placement agent literally came to his house and wrote down 2% of 500 equals X, and 2% of 150. What am I missing? And my friend, who was a bit incredulous, said, if I do what you want me to do, there won't be a fund too. That's a microcosm of what's wrong in the industry, and I think it's going to continue. So I think family offices, it is a superior model, but we've got a lot of work to do it, and it's going to start at the university level.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.